Welcome back to Talk Tickers. Today feels less like we're just reviewing quarterly numbers and, well, more like we're watching a controlled demolition of the old economy.
That's a great way to put it.
We're looking at the absolute cutting edge of industrial evolution, but not in the way you'd think. It isn't just building new factories. It's about rewiring the whole financial architecture that supports them.
It really is. It feels like a cleanup operation across the board. You've got these titans of industry and then the quiet movers of capital, both reporting earnings, and the theme is just identical. Get lean, get focused, or get left behind.
It's brutal.
But fascinating.
And we're starting with the big one. The earnings call that just dropped, Honeywell, ticker HON. But to call this an earnings review, that feels like a massive understatement. This is a breakup story.
It is. Honeywell is effectively dissecting itself. They're taking this legacy industrial giant, a staple of American manufacturing for a century,
Right.
and splitting it into pieces. They're divorcing aerospace from automation. And then amidst all that chaos, they're betting the entire farm on quantum computing.
It's such a wild juxtaposition.
Yeah.
You have jet engines on one side, heavy, physical, loud, smells like jet fuel, and then quantum physics on the other.
Yeah.
But before we get lost in the particle physics, we have a market pulse sidebar we have to flag. While giants like Honeywell are restructuring, the small cap regional banks are just quietly rallying.
We are keeping a very close eye on Civista bank shares, ticker CIVB. They popped nearly 6% after their results.
Wow.
And it sounds like a boring regional bank story, but it's actually a perfect counter-narrative to Honeywell. It's a classic M&A play that really acts as a momentum signal for the broader economy.
Okay, so here's our mission for this deep dive. We're going to dig into the Honeywell transcript to find the hidden value in this spinoff. We need to decode the quantinuum hype. Is it real innovation, or is it just sci-fi buzzwords to pump the stock?
Good question.
And finally, we have to figure out if their guidance for 2026 is, conservative or completely delusional.
All right, let's do it. Let's start with the scoreboard. Honeywell's Q4 2025 results.
The headline numbers, they look solid. Sales were up 11% organically. For a company this size, double-digit organic growth is a serious beat.
A huge.
Adjusted EPS came in at $2.59, up 17% year over year.
Earnings per share is nice, but the cash flow, that's the real story for me. $2.5 billion in free cash flow just in the quarter.
In one quarter.
Yeah. And for the full year, they hit $5.1 billion. Look, when you're about to go through a complex divorce, which is expensive, you need liquidity. That cash pile is their ammunition.
I listened to the call, and the vibe, it wasn't just we survived. It was aggressive confidence. Management explicitly said they exceeded expectations. But the number that stood out to me was the backlog, a record $37 billion plus.
That backlog is so critical because it's not just hopes and dreams or, a sales pipeline. These are signed contracts. It effectively locks in future revenue.
Right.
And if you look at the composition of that backlog, it tells you exactly where the economy is heating up. Aerospace was up 11% organically.
And that's commercial original equipment and defense leading the charge.
Exactly.
And building automation was up 8%, and that was largely driven by data centers and healthcare. It feels like data centers is the answer to every question in the stock market right now.
Pretty much. If you have exposure to the servers, you're winning. We're just seeing a massive CapEx cycle there.
But it wasn't all green lights. We have to look at the soft spots to really understand the risk,
I
right?
do. Industrial automation, specifically the sensing and safety stuff, was flat to slightly up. And energy and sustainability solutions, or ESS, was actually down 7%.
Oh, that's interesting. Sustainability was supposed to be the next big growth vector. Why is it down?
Project deferrals, mostly in petrochemicals. It's a signal that, while the digital economy is booming, the heavy industrial side, the refineries and chemical plants, is hesitating.
So they're not upgrading their safety sensors as fast as Amazon is building server farms.
That's it, exactly. It's a divergence in the economy.
Okay, so that's the snapshot of where they are today. But the reason we're talking about Honeywell isn't Q4 2025. It's about topic one, the great separation. The aerospace spinoff coming in Q3 2026.
This is the sum of the parts thesis in action. The argument is simple. Honeywell, as a conglomerate, is trading at a discount because it's just too complex.
Right.
Investors don't know how to value a company that makes thermostats, warehouse robots, and fighter jet engines all at once. It confuses the algorithms. It confuses the portfolio managers.
It's the classic jack of all trades, master of none penalty.
Exactly. So by spinning off aerospace, which is, arguably their crown jewel, into a standalone public company, they hope to unlock massive value. The market usually gives a much higher multiple to a pure-play defense contractor than it does to a messy conglomerate.
And they've already appointed the team, right? Tim Courier, CEO, Josh Jeepson as CFO.
Yeah, and they brought in Craig Arnold from Eaton Core as chair, which is a very heavy hitter move. Eaton is basically the gold standard for industrial management right now.
Okay, but I want to drill down on something the current CFO, Mike Stake, mentioned on the call. He talked about stranded costs. For the listener who isn't an accountant, can we unpack that?
Yeah, it sounds negative, but it's actually where the opportunity is hiding. When you split a company in two, you have all this overhead, HR departments, IT systems, corporate headquarters, legal teams that used to support the whole beast.
Right.
When you split, those costs don't just magically disappear overnight. They get stranded, left behind.
So it's like moving out of a house you shared with a roommate. You split up, but you're still stuck paying the full electric bill and the full internet bill yourself for a while.
That is the perfect analogy. Suddenly, your personal margin looks terrible because your costs stayed the same, but your income, the roommate's rent money, is gone.
I see.
But here's the arbitrage. Management has a detailed plan to eliminate these stranded costs within 12 to 18 months post-spin.
So the play is, the company looks inefficient right after the split, the stock maybe takes a hit or just stays flat because the numbers look messy, and then...
and then they cut the fat. As those costs get removed, profitability just pops. It's a guaranteed or at least a highly planned margin expansion. It's an efficiency play disguised as a crisis. Smart money looks for that temporary dip to buy the recovery.
I love that. Inefficiency now, margin pop later. There was another detail in the Q&A about the aerospace contracts that felt like a hidden gem. They're renegotiating long-term commercial OE contracts that are 5 to 7 years old.
This is huge. And I don't think the retail market fully gets it yet. Think about the inflation we've seen since 2020. These old contracts were pricing in labor and materials from a pre-inflation world.
So they were selling at 2019 prices, but building with 2025 costs.
Exactly, crushing their margins. So renegotiating means they finally get to update the price tag. They are repricing all that inflation into the deal.
Which is a massive tailwind.
It's huge. They aren't just going to sell more engines. They're going to sell them at 2026 prices. That drops straight to the bottom line. It's like getting a 20% raise for doing the exact same job.
Which brings us to topic 2, portfolio cleanup. I'm calling this the garage sale. Honeywell is selling off productivity solutions and warehouse and workflow solutions in the first half of 2026. This confused me at first. Isn't warehouse automation a booming sector? Why ditch the robots?
It is booming, but it's a race to the bottom. The logistics and warehouse automation space has become this low-margin rat race. You have 100 competitors making conveyor belts and barcode scanners. It's capital-intensive, and the pricing power is just gone.
Everyone is undercutting everyone else.
Right, so Honeywell is looking at that and saying, we don't want to fight for scraps. By selling that off, they're focusing the remaining industrial automation business purely on sensing and measurement.
So high-tech sensors.
Yes. Sensors for medical devices, aerospace guidance, semiconductor manufacturing. These are high-precision, high-margin products where Honeywell has a real moat. It's very hard for a competitor to replicate their tech.
They're trading volume for quality.
Exactly. The result is a much cleaner, simpler business model focused on 3 cores: process, buildings, and industrial sensing.
Okay, so they dump the heavy lifting robots and keep the high IQ sensors. Speaking of high IQ, let's pivot to the sci-fi stuff. Topic 3, the tech lottery ticket. We have to talk about Quantinuum.
Ah, yes. This is the wild card. This is the thing that makes Honeywell so weird.
They raised $840 million at a $10 billion pre-money valuation. On the call, Vimal Kapoor, the CEO, he was hyping up the launch of Helios. He called it the world's most accurate commercial quantum computer. Now, be honest. Is this real, or is this just CEO buzzword bingo to get the stock price up?
Well, the language they used was very specific, which gives me some comfort. They're talking about high-fidelity qubits. In quantum computing, the number of qubits doesn't matter as much as the quality or fidelity of them.
Okay.
If you have a lot of qubits, but they make tons of errors, your computer is useless. Honeywell claims to have solved the error correction problem better than anyone else.
But here's the tension for investors, right?
Yeah.
Quantinuum is expensive to run. It's a 30 basis point headwind to margins in 2026 because of all the R&D spend. It's burning cash.
That's the innovation tax. But look at the partners. NVIDIA, JP Morgan, Amgen, you don't get JP Morgan investing in a science fair project. They're betting that quantum computing will revolutionize financial modeling. Vimal is positioning this not as a side project, but as the future growth engine of the entire company.
They also mentioned integrating it with their Honeywell Forge platform using an agentic AI overlay. Agentic is the buzzword of the year.
It is, but in this context, it's actually really powerful. It means using quantum computing to power AI simulations for industrial processes. Imagine an AI agent that can simulate millions of chemical reactions in seconds to optimize a refinery. That's the convergence they're betting on.
If they pull that off, it changes the valuation multiple of the entire company. It stops being a boring industrial stock and starts trading like a tech stock.
That is the big upside case. But let's ground this in reality. What does the guidance say for 2026?
The guidance is measured. They're forecasting sales of $38.8 billion to $39.8 billion. That's roughly 3 to 6% organic growth. EPS is expected to be $10.35 to $10.65.
It's prudent. Actually, I'd call it conservative. The key takeaway from that guidance is that it assumes no rebound in underlying industrial market demand.
Wait, really? They aren't betting on the economy getting better at all?
Nope. They are betting entirely on self-help. Productivity, pricing power, and executing the spin-off. If the economy booms, that's just icing on the cake. They've set the bar at a level they can hit even if the macro environment stays flat.
That's a safe place to be. Speaking of pricing, they expect about 3.5% price realization in 2026.
Which proves they have pricing power. Even with labor costs up 3 to 4% and electronics prices rising, they can pass that on to customers. That's the definition of a quality business in an inflationary environment.
Okay, let's switch gears completely. We've talked about the industrial giant cleaning up by shrinking. Now I want to look at the financial plumbing. Let's bring in the Civista factor.
This is a fascinating contrast. While Honeywell is cleaning up by spinning things off, Civista Bank Shares, this regional bank, is cleaning up by acquiring.
The stock jumped almost 6% on their earnings. And the catalyst wasn't some new app or AI. It was the acquisition of Farmers Savings Bank.
Right. They bought a bank to fix a specific problem, their funding costs. By acquiring Farmers, they brought in $236 million in low-cost deposits.
For the listener who doesn't speak banker, why do deposits matter so much right now?
Because interest rates are still relatively high. Banks have to pay a lot to keep your money in a savings account. If they don't pay you 4 or 5%, you'll move your money to Apple or Robinhood.
And it kills the bank's profit margin.
Exactly. The bank's cost of goods sold is the interest they pay you.
So Civista's solution was, just buy a bank that already has cheap money.
Exactly. They bought a bank with a loyal customer base, probably in rural areas, given the name Farmers, who aren't moving their money every time the Fed twitches. These are low-cost deposits. Civista instantly lowered their cost of doing business.
It connects perfectly to Honeywell. Honeywell is managing stranded costs. Civista is managing deposit betas.
And deposit beta is just a fancy term for how fast you have to raise your interest payouts when the Fed raises rates. Civista just cheated the system by buying a balance sheet full of cheap money.
I love it. Both companies are fighting macro headwinds, just with different weapons. Honeywell uses a scalpel, Civista uses a net.
And that brings us to the most fun part of the show, the so what.
Yes. It is time for our This Is Not Financial Advice segment.
Obligatory disclaimer, we are just two voices on a recording. Please do your own research. This is for entertainment purposes only.
Okay, I've got a trade idea that's hiding in plain sight. I call it the quantum stub play. You buy Honeywell, ticker HON, right now.
Okay, pitch me. Why now?
You buy it before the Q3 2026 spinoff. Right now, the market looks at Honeywell and sees a boring, slow-moving conglomerate. It trades at a discount. But post-spin, look what you own. You get shares in the new independent aerospace company.
Which is the safe compounding asset. Defense budgets aren't going down. People aren't going to start flying.
Exactly. But T, because you bought the parent company, you also keep the automation stub, the company that's left behind. And inside that stub is the majority stake in Quantinuum, that $10 billion quantum computing unicorn.
I see where you're going. You think the market is mispricing the leftovers.
Right now, the market treats the quantum unit as a cost center. It's a margin drag, like you said. Investors hate it. But once aerospace is gone and automation stands alone, that quantum unit becomes the star of the show.
It could re-rate. Suddenly you're not holding a boring industrial stock. You're holding a deep tech stock.
You're basically buying a boring industrial and getting a free call option on the future of physics. If Quantinuum goes public or gets bought out, the stub skyrockets.
It's a classic sum of the parts trade on steroids. You're betting the market is bad at math and hates complexity.
The market is always bad at math when it comes to conglomerates. That's why hedge funds exist.
That is a solid pitch. But here's the counter risk. What if quantum is still 10 years away? Then you're just stuck holding a low-growth automation company with a massive R&D bill.
Fair point.
Yeah.
But that's why you have the aerospace shares as insurance. What's your play?
Mine is a bit more tactical. I call it the NIM expansion squeeze. It's a play on Civista, CIVB.
The regional bank.
Yes. This is an outrageous yield curve play.
Sure.
Civista beat the street, estimates significantly 75 cents adjusted EPS versus 61 cents expected. But the guidance is the key. They guided for net interest margin, or NIM expansion, of plus 5 to 7 basis points in 2026.
Expansion is a magic word for banks right now. Most are seeing compression.
Exactly. That's why it's a squeeze. They just acquired that cheap funding we talked about. Now, if the Fed cuts rates mid-year, which is implied in their guidance, their deposit costs drop much faster than their loan yields.
So their profit margin just widens automatically.
It's pure mechanics. You go along the regional bank that just fixed its funding problem overnight via M&A. It's a boring scale trade that the algo traders are just waking up to. That 6% pop could be just the beginning if they hit that margin target.
So we have a quantum call option and a yield curve squeeze. Two very different ways to play this whole cleanup theme.
Both rely on management executing a complex maneuver, though. Honeywell has to spin without breaking the company. Civista has to integrate a new bank without losing customers.
Execution risk is real. So let's wrap this up. What are the big takeaways?
Honeywell is a self-help story. Spin aerospace, sell the warehouse business, pump the quantum hype. They're shrinking to grow.
And Civista is a scale-up story, buying deposits to fuel loan growth.
But if we connect this to the bigger picture, looking at the Honeywell transcript, the vocal core kept mentioning those agentic ways of working.
That stuck with me too. It feels like a signal.
It raises a provocative thought for the listener. Are we looking at the last days of the traditional industrial conglomerate? I mean, if the factory floor can be simulated by quantum computers and managed by AI agents, is the factory just a server rack in disguise?
That is the thought that will keep me up tonight. The digitization of heavy industry means the difference between a tech company and a manufacturing company is just disappearing.
It's coming faster than we think.
Well, on that terrifying but exciting note, we're going to sign off. Keep watching the tickers.